Most people have no idea there's an ideal dollar amount that you should have in your pre-tax retirement accounts the day you retire. And going above it can dramatically increase the taxes that you pay for the rest of your life. I used to believe the traditional max out your pre-tax strategy too, until I realized it often creates a massive tax trap in retirement. So in part 3 of this series, I'm going to show you exactly what your pre-tax balance should be at your retirement if your goal is to generate 100% tax-free income. I'll have an example of both a married couple and someone who's single or divorced. And here's why this matters so much. Most retirees don't get hit with high taxes because they invested poorly. They get hit because they saved in the wrong account type for too long and no one ever showed them how to balance pre-tax, Roth, and taxable buckets. Your pre-tax balance determines whether your Social Security gets taxed, whether you trigger Medicare IRMA surcharges, how much of each RMD gets pushed into higher brackets, and ultimately how much control that you have over your tax bill in retirement. So in this video, I'm not just giving you a number, I'm going to show you why that number exists and how to calculate it for your situation. Because the earlier you understand this, the easier it is to build a truly tax-free retirement income plan. Here's where most people miss how this puzzle works. As of 2026, the standard deduction, if you're single, is $16,100. For a married couple filing jointly, it's $32,200, and if you're 65 or older, you get an extra boost with a bonus deduction of $1,650 per person if you're married and $2,050 if you're single, bringing a total deduction if you're married to $35,500, not including that temporary senior bonus. This number will generally increase with inflation over time. And right now, over 90% of households take the standard deduction instead of itemizing, which makes this number critical to your plan. Think of it as the free space where income can land without being taxed. If your required minimum distributions, those withdrawals the IRS requires starting at age 73 or 75, depending on your birth year, stay under that deduction, they could be 100% tax-free. And because provisional income determines whether your Social Security is taxed, keeping RMDs within that free space also reduces the risk of losing part of your Social Security benefits to taxation. All right, here's the interesting part. Most people only worry about having too much in pre-tax accounts, but too little can cost you just as much. For example, let's say you retire with $100,000 in pre-tax accounts. At age 73 in 2026, your RMD will be a little over $3,700. That leaves more than $28,000 of unused standard deduction space each year. Now, some of that would be eaten up by Social Security benefits if you get them, but that's still a big part of a standard deduction that's not used. It's even more when you take into account bonus deductions for being 65 or older. In other words, you missed out on years of tax-deferred compounding and you didn't even use the free income the IRS allows in retirement. Smart planning is about hitting that sweet spot, not too much and not too little. Aim for a balance that's large enough that your RMDs fill up the standard deduction, maximizing your tax-free retirement income. But here's the catch. To figure out the exact IRA balance that lets you take tax-free withdrawals, you can't look at your account alone. You also need to consider your Social Security benefits. Why? Because the IRS combines Social Security with other income, like IRA or 401k withdrawals, to determine how much of your benefits are taxable. This is what the IRS calls provisional income. Provisional income is basically the IRS's way of figuring out if some of your Social Security benefits are taxable. It's your adjusted gross income plus tax-free interest plus half of your Social Security. And if that total goes above certain thresholds, up to 85% of your Social Security could be taxed. Even if your RMD is modest, your Social Security could push your total income into a range where part of your benefits become taxable. But just because some benefits are considered taxable doesn't mean that you'll actually owe federal income tax on them. The sweet spot that we're aiming for is to find the RMD amount that, when combined with the taxable portion of Social Security, stays within your standard deduction. This allows you to withdraw money from your pre-tax accounts without paying federal income tax. Let's look at a hypothetical couple to see how this works in real life. We'll plug in their IRA balances, RMDs, and Social Security benefits to figure out exactly how much they can withdraw each year tax-free. Before we dive into the numbers, here are our assumptions for Marsha and Don in today's dollars and projected at age 75. Let's imagine Marsha and Don both age 55 in 2026. Because they were born after 1959, the IRS moved their first required minimum distribution to age 75, which is why all our calculations start there. It's when forced withdrawals begin. At age 75, they're each projected to receive $24,000 per year in Social Security benefits in today's dollars. We will assume 3% annual COLA increases, which projects to $43,350 per year at age 75. If today's $35,500 standard deduction grows at 3% annually over the next 20 years, it could be about $64,000 by age 75. Now remember, not all Social Security is automatically taxable. The IRS calculates the taxable portion based on total income. In this example, the combination of RMD plus the taxable portion of Social Security must stay under the $64,000 standard deduction to remain tax-free. Here's how it works. Not all of Social Security is automatically taxable. The IRS applies a formula based on total income. Some of the benefit becomes taxable depending on how much income that you have from other sources, like your IRA or your 401k RMDs. By solving this, we can find the exact RMD that, when added to the taxable portion of Social Security, equals the standard deduction. After doing the calculation using IRS rules, taxable portion of Social Security equals $32,350. Maximum RMD equals $31,650 per year. Total taxable income equals $64,000, and that equals no federal income tax. All right, now that we know what the maximum RMD can be, we can figure out how large of an IRA they can have when those distributions start. Using the IRS divisor for age 75, which is 24.6, we can figure out the maximum combined pre-tax IRA and 401k balance. The IRA balance equals the previously determined RMD of $31,650 times 24.6. That equals roughly $777,000. This is the sweet spot for Marsha and Don. Large enough to maximize the tax-deferred growth, but not so large that the forced withdrawals trigger taxes on Social Security. With more and more people in their 50s single or divorced, I wanted to also show this example. Jennifer is also 55 in 2026, and like Marsha and Don, her first required minimum distribution will be at age 75 because she was born after 1959. Here's what we are assuming in today's dollars and projecting to age 75 with a 3% annual cost of living adjustment. Her Social Security at 75 is also $24,000 in today's dollars and will be $43,350 when accounting for the COLA. The 2026 standard deduction for someone who is single and age 65 or older is $16,100 plus $2,050 for being 65 or over. We're not including the temporary senior bonus deduction. Remember, even though she's 55, we're using the 65 and over standard deduction because she will be over that age when her RMDs start. To figure out how much Jennifer can withdraw from her pre-tax retirement accounts without paying federal income tax, we combine her RMD with the taxable portion of her Social Security. Remember, Social Security is only partially taxable depending on her total income. The IRS uses provisional income to determine how much is taxed. But the key idea is this. We want the RMD plus the taxable Social Security to stay within the standard deduction. After running the numbers using the IRS rules, the maximum RMD equals $18,000 per year. The taxable portion of Social Security equals $15,000. Total taxable income is about $33,000, so there's no federal income tax. Now, using the IRS RMD divisor for age 75, which is 24.6, we can calculate her maximum pre-tax IRA balance. The IRA balance equals $18,000 times 24.6, and that equals $442,800. This is Jennifer's sweet spot. It's a large enough IRA balance to benefit from tax-deferred growth, but it's not so large that forced withdrawals trigger taxes on the Social Security. Now remember, personal finance is just that. It's personal. Your Social Security, pensions, and other sources of income may be very different from Marsha and Don's or Jennifer's. More Social Security or a pension? Well, that reduces how much RMD that you can take tax-free. Maybe less? Well, you may have more room for a larger pre-tax balance in your IRA and 401ks. This calculation gives you a starting point, a target for your pre-tax retirement assets to stay within the 0% tax bracket. The principle is universal. Aim to keep RMDs within the standard deduction and then use Roth accounts, HSAs, and taxable accounts for the rest of your retirement spending. Look, we know tax laws will continue to change, and today's tax brackets are historically low. So ask yourself, will you really be in a lower tax bracket when you retire? Will you have unused standard deductions waiting for you? By planning strategically now and possibly converting some pre-tax money to Roth in your lower income years, you can line up future withdrawals with your standard deduction. That's the definition of tax efficiency, using every inch of the rules to keep more of what you've earned. Now, I realize not everyone will achieve a 100% tax-free income, but almost everyone can reduce their tax burden with thoughtful planning. The goal is simple. Maximize your after-tax income, extend the life of your savings, and leave a stronger legacy behind. Don't spend decades building up accounts only to watch Uncle Sam take a giant slice when you need it most. Instead, balance your pre-tax accounts to use your standard deduction fully, protect your Social Security from taxation, and spend your retirement years without unnecessary tax surprises. And if you own a business and you've built a retirement portfolio and are interested in optimizing your financial planning with next level analysis, you can get started working with me today by visiting celestialwm.com and head over to my resource center and learn more about my financial planning process by watching my 35-minute complimentary training. And now that you know how to calculate your ideal pre-tax balance, it's time for part 4 of this series, why Roth accounts are a critical piece of the puzzle and how they can help you achieve truly tax-efficient retirement income. In the meantime, watch this video next to supercharge your net worth.